This is Chapter 11, Property, Plant and Equipment and Intangible Assets Utilization and Impairment. So, cost allocation and overview. The matching principle requires that the part of the acquisition cost of the property, plant and equipment, and intangible assets be expensed in the period when the future revenues are earned. Depreciation, depletion, and amortizations are cost allocation processes used to help meet the matching principle. So some of the cost is allocated to each period. So first you have the acquisition cost, and then technically the expense is depreciation of the asset used to produce a product and is a product cost that does not become an expense until the product is actually sold. So here's cost allocation overview. If it's plant, property, or equipment, which we've done some of this already, it is called depreciate. You're going to debit depreciation, and you are going to credit accumulated depreciation. And it might be depreciation equipment, accumulated depreciation equipment, or property or plants. If it is a natural resource, then you are going to debit depletion, credit natural resource asset. And if it's an intangible, you're going to debit amortization, credit intangible asset. Caution, depreciation, depletion, amortization are all processes of cost allocation. It is not the valuation of the asset. So, here's an example. Land and buildings, machinery and equipment, office furniture and equipment, and land improvements. Total is $575,000. Less accumulated depreciation is net PP&E, plant, property, and equipment. This is depreciation on the balance sheet. This is accumulated over all the periods, not what is current depreciation. So, measuring cost allocation. Cost allocation requires three pieces of information for each asset. One, we need to know the service life, also known as useful life. This is the estimated expected use from an asset. Useful life. We need an allocation basis, total amount of the cost to be allocated. Cost residual value, that is at the end of the useful life, sometimes also called salvage value. And then we need an allocation method, the systematic approach used for allocation. Sometimes we'll talk about straight line method, other times there's an accelerated depreciation method. It all depends on the systematic approach and what we're doing it for. For the record keeping or for tax purposes, that would be different. Depreciation. There's time-based methods. Straight line. Basically, you take the total cost of the asset and divide by the number of useful years in the useful life. Then there are accelerated methods, which is sum of the digits, or SYD, or there's double declining balance. And then activity-based methods, units of production method. So let's talk about straight line. This is most frequently used when we do this in accounting and the easiest to apply, basically. So annual straight line depreciation equals the asset cost minus residual value, because we won't depreciate any residual value. This is how much the asset is worth when the useful life is over. Sometimes it's nothing. This is also called salvage value. So we take acquisition cost, purchase price, minus residual value, divided by service life in years. The most widely and easily understood, results in the same amount of depreciation each year of the asset's life. On January 1st, we purchased equipment for $50,000. It has a service life of 5 years, an estimated residual value of $5,000. So $50,000 minus the 5 is 45, divided by 5 equals $9,000. So here's an example of a depreciation schedule. There's also amortization schedules for loans. So year one, we're going to debit depreciation, accumulated depreciation, credit. The accumulated depreciation balance is $9,000, and our book value is the $50,000 cost less accumulated depreciation, which is $41. Year two, debit, credit, but accumulated balance is now this plus this equals $18,000. And then 41 minus the extra $9,000 is 32. Year three, again, straight line. Now we have accumulated depreciation of $27,000. So minus another $9,000. Continuing on all the way to year 5, and what we have after accumulated depreciation is the residual value. It is the book value at the end of the asset's useful life. Accelerated methods result in more depreciation in the early years of an asset's useful life and less depreciation in later years of an asset's useful life. Note that the total depreciation over the asset's useful life will be the same, whether you use straight line or you use some accelerated method. It doesn't change the amount, it just changes the years that you would take the amount in. So sum of the year's digits equals cost minus residual value times remaining years of useful life divided by sum of the year's digits. On January 1st, we purchased the equipment for $50,000 cash. Has a 5-year estimated life and a residual value of $5,000. Using sum of the year's digits depreciation calculates the first 2 years. Okay. Year 1. Useful life 5 times 5 plus 1 divided by 2, or 30 divided by 2. That is 15. So 50,000 minus the $5,000 residual times 5 over 15. This equals $15,000 of depreciation in year 1. In year 2, it's 50,000 minus the 5,000. That remains the same. But now it is 4 years remaining, and the sum of the digits is 15. So this is 4 divided by 15 times this number is 12,000 in year 2. And it will continue to go down. And here's what the full schedule would look like. 15, 12, 9, 6, 3. Remember, it was 9, 9, 9, 9, 9 on the previous one, which is straight line, the easiest to apply. But you end up in the same position. It's just that depreciation expense is front-loaded, as we call it. Declining balance is based on straight line rate multiplied on an accelerated factor. Computations initially ignore residual value. Stop depreciating when book value equals residual value. Double declining balance is DDB, book value times 2 times straight line. Note that the book value declines each year. On January 1st, we purchased equipment, the same equipment, $50,000 cash, has a useful life of 5 years, and estimated residual value of $5,000. What would be the depreciation for the first 2 years using double declining balance? So, book value times 2 times the straight line rate. Book value times 2 times 20%. $20,000 would be the first year. So 50 minus 20 times 2 times 20 would equal $12,000 of depreciation in the second year. So this would be double declining balance. You're going to debit $20,000 to depreciation, then 12, then 7,200, then 4,320, and then you're going to stop depreciating once you hit the residual value of $5,000. So as you can see the chart, instead of being straight across, it's significantly more in the first year. The units of production method. Depreciation rate per unit of activity equals acquisition cost minus residual value divided by estimated life in units of activity. So depreciation equals depreciation rate per unit of activity times unit of activities. Okay, now we purchased $50,000 equipment for $50,000. We expect to produce 100,000 units, and it has an estimated residual value. So instead of 5 years, we're doing units, right? If 22,000 units were produced in year 1, what would be the depreciation? Depreciation, 50,000 minus 5,000 divided by 100 equals 45 cents per unit. Then what we're going to do is multiply the number of units that we had this year times the depreciation rate per unit. So 22,000 times 45 cents, or 9,900 in depreciation. Various depreciation methods. This is a recent survey. So 492 out of all of these places surveyed used straight line. It's just easier. For tax purposes, they might use something else, but basically on their books, they're using this. Then the next highest was accelerated, which they didn't specify which type. Then declining balance, actually units of production, then declining balance, then some group composite number, and then the least is the sum of the year's digits. So there are differences for IFRS, but we're not going to talk about that today. Group and composite methods. Assets are grouped together by common characteristics. An average depreciation rate is used. Annual depreciation is the average rate times the total group acquisition cost. Accumulated depreciation records are not maintained for individual assets. So basically equipment, no matter what the equipment is, has a straight average rate. If assets are in a group are sold or new assets added, the composition rate remains the same. When an asset in the group is sold or retired, debit accumulated depreciation for the difference between the asset's costs and the proceeds. Now, if we're talking about depletion of natural resources, remember this isn't depreciation, it's depletion. As natural resources are used or quote-unquote depleted, the cost of the natural resource must be allocated to the units extracted. This approach is based on the units of production method. So your depletion rate per unit is the cost of the natural resource minus the residual value divided by the estimated recoverable units. Remember, we're not making something, it's a natural resource. So total depletion cost equals the unit depletion rate times units extracted. Now an example. ABC Mining acquired a tract of land containing ore deposits. Total cost of acquisition and development were $1.1 million. The estimated land contained 40,000 tons of ore that will be sold for $100,000 after the land will be sold for $100,000 after the coal is mined. What is the depletion rate? All right, $1 million, and we subtracted, so it's 1 million because we subtracted the 100,000 because there's a residual value. So we get 1 million divided by the tons equals $25 per ton. If they mined 13,000 tons in the first year, the depletion would be $25 times 13,000 tons, or 325,000 in depletion expense. Now, if we're talking about an intangible asset with a finite useful life, which means there is an end to it, an infinite useful life means we have no determination on when it will end, then we wouldn't be able to amortize. A finite, we allocate capitalized costs over the useful life using straight line method, normally with a zero residual value. An intangible's useful life may be limited by legal, regulatory, or contract provisions. In other cases, the useful life may be less than the legal or contractual life. The amortization journal entry is below. Amortization expense, credit, intangible asset. A contra asset is account generally not used when recording the amortization of intangible assets. So on the other one, we had a contra asset of accumulated depreciation. That is not true for intangibles. It just reduces the value directly. So Torch developed a new device. Patent registration costs consisted of $2,000 in attorney fees, $1,000 in federal registration. The device has a useful life of 5 years. What is the amortization expense for year 1? So cost divided by contractual life, or $3,000, add these two together, divided by 5, $600 per year. So debit amortization expense, credit patent. Intangible assets that are not subject to amortization. Goodwill and trademarks are not amortized. They are subject to assessment for impairment of value and may be written down. Partial period depreciation. When prorating depreciation based on date of acquisition is time-consuming and costly, a common used alternative is called half-year convention. Basically, if you're instead of trying to prorate it on days or something like that, or mid-month, you take half a year in the year of acquisition and the other half in the year of disposal. So basically, the first year you'll only have half a year, and the year of disposal you'll take the remaining half. So changes in estimates. There's also changes in estimates, because what if the estimated life or the estimated residual value changes? Changes in estimates are accounted for prospectively, which means we don't go back and adjust. We just move forward and adjust. The book value less any residual at the date of the change is depreciated over the remaining life. A disclosure note would describe the effect. On January 1, we purchased equipment for $30,000. It had a useful life of 10 years, no residual. At the beginning of the fourth year, we decided that there were only 5 years remaining instead of 7. Calculate the depreciation from the fourth year on using straight line. Actual cost was $30,000. Accumulated depreciation was $3,000 a year for 3 years. Now we have remaining book value of $21,000. We're going to divide that straight line by the remaining 5 years. It would have been 7, right? And now our depreciation is going to be $4,200. A change in depreciation, amortization, or depletion method is considered a change in an accounting estimate that is achieved by a change in an accounting principle. We account for these changes prospectively, exactly as we would any other estimate. On January 1st, we purchased office equipment for $400,000. Matrix expected a residual value of $40,000 and a service life of 5. Matrix uses double declining balance to depreciate this asset. During 2013, they switched from double declining balance to straight line. The residual value remained at 40. Let's determine the amount of depreciation. Okay, so they started using double declining and then they chose to change their depreciation method. So depreciation using double declining for the first 2 years totaled $256,000. The asset cost was $400,000. We subtract the accumulated depreciation, and we have an undepreciated balance of $144,000. Subtract the residual, which still remains at $40,000, and we have a new amount to depreciate with 3 years left. So we have an annual depreciation of $34,667. Journal entry would be debit depreciation expense, credit accumulated depreciation. Error correction. If there are errors found in subsequent accounting periods, they are corrected by entries that restate the incorrect account balance, restating the prior period's financial statement, or reporting the correction as a prior period adjustment to beginning retained earnings. In addition to a disclosure note is needed to describe the nature of the error and the impact of its correction on net income, income before extraordinary items, and earnings per share. So this isn't a change in estimate, it's an error. That's why we have to go back and restate or adjust prior beginning balances. If an asset becomes impaired, the accounting treatment can differ. If it is a long-term asset to be held and used, tangible and intangible with finite lives, then there's tangible with indefinite life, and there is goodwill. If it's a tangible with a finite life, you would test for impairment of the book value when it's suspected that the book value might not be recoverable. If it's intangible, you would test for impairment at least annually. If it is goodwill, you would test for impairment of the value when it is likely that the fair value of the reporting unit is less than the book value. And if it's a long-term asset held for sale, you would test for impairment of the value when it's considered for sale. Finite life assets to be held and used. An asset is impaired when the undiscounted sum of its future cash flows is less than its book value. We're actually going to stop here and not get that into impairment. That will be a second video.